The meeting was held in secret, November 1910. A private rail car departed from Hoboken, New Jersey, under conditions that its passengers were instructed not to discuss. The men aboard used first names only, no surnames, no professional titles, no identifying information that could be reported if the journey became known. They were traveling to Jekyll Island, Georgia, a private retreat owned by a club whose membership included some of the wealthiest men in America. They would remain there for 9 days. What they produced on Jekyll Island was the document that became, after 2 years of legislative revision, the Federal Reserve Act of 1913. This is not a conspiracy. The Jekyll Island meeting is documented. The participants are known by name: Nelson Aldrich, the Senate Republican leader; Frank Vanderlip of National City Bank; Henry Davison of J.P. Morgan; Paul Warburg of Kuhn, Loeb and Company, and others. Their presence at Jekyll Island is in the historical record. Aldrich himself described the meeting in a magazine article published years later. The secrecy was real, and the participants acknowledged it openly after the fact. What they were designing in those 9 days was a solution to a banking problem that had destabilized the American economy repeatedly since the Civil War. The Panic of 1907, a financial crisis so severe that J.P. Morgan himself had to personally organize a private bailout to prevent a cascade of bank failures, had made the absence of a centralized monetary authority visible in a way that could not be ignored. In 1910, the United States had approximately 20,000 banks. The majority were state-chartered institutions, independent, locally owned, capitalized by local investors, and lending primarily to local borrowers. They did not coordinate. They did not share reserves. When a panic spread, they failed independently and sequentially, each one pulling the next down. The system was not orderly, but it was something the Federal Reserve Act would not preserve. It was local. Here is what the pre-1913 banking system actually looked like. The number most cited in the historical literature is not $8,000. It is closer to 20,000 banks operating in the United States in the years immediately preceding the Federal Reserve Act. The 8,000 figure refers specifically to national banks, institutions chartered under federal law, subject to federal examination, required to hold specified reserve ratios. The remaining banks were state-chartered, operating under a patchwork of 50 different regulatory frameworks with reserve requirements that varied dramatically from state to state and in some cases were not enforced at all. This was not a unified system. It was an ecology. Thousands of independent institutions, each one a product of the local economy it served, each one capitalized by local investors whose money was tied to local land, local crops, local commerce. A bank in rural Kansas held reserves in wheat country. A bank in Lower Manhattan held reserves in railroad securities. They were not the same kind of institution. They shared a name and not much else. The instability this created was real and documented. The period between the Civil War and 1913 produced a financial panic on average, roughly once per decade: 1873, 1884, 1893, 1907. Each panic followed a similar pattern: a shock to confidence in one sector, a run on deposits, a contraction of lending, a cascade of bank failures that spread from the epicenter outward through correspondent banking relationships that connected institutions across states. The failure of a New York trust company could produce bank runs in Ohio. The collapse of a railroad bond could empty a savings account in Georgia. The reformers who designed the Federal Reserve System were not wrong about the problem. The panics were real. The human cost of each contraction, the farms foreclosed, the businesses closed, the workers displaced, was documented in congressional testimony and in the press. The Aldrich-Vreeland Act of 1908, passed in the immediate aftermath of the 1907 panic, was an emergency measure that both parties acknowledged was not a permanent solution. And here is where the bridge of relevance matters, because the experience of living in an economy where the money supply is determined by decisions made at a distance, by institutions you did not choose and cannot directly influence, is not a condition that began in 1913. It is the condition that the Federal Reserve Act formalized. Before 1913, the money supply in a given community was determined, in large part, by the lending decisions of institutions that were physically present in that community, owned by people who lived there, accountable to depositors who could walk through the door. That accountability was not efficient, it was not stable, but it was local, in a way that the system that replaced it was not designed to be. The congressional debate over the Federal Reserve Act ran from 1912 through December 1913. It was not a quiet debate. The opposition was substantial. Representatives of rural states, of small bank interests, of agrarian constituencies that had spent the preceding decades fighting what they called the money trust, the concentration of financial power in the hands of a small number of New York and Boston banks that controlled, through correspondent relationships and board interlocks, a disproportionate share of American credit. The money trust was not a conspiracy theory. It was the subject of a formal congressional investigation, the Pujo Committee, which reported in 1913 that a small group of financial institutions and their affiliated individuals controlled, through interlocking directorates and correspondent banking relationships, a significant concentration of American financial resources. The committee's findings are in the congressional record. They are not disputed by mainstream historians. What the Pujo Committee documented was the system that existed before the Federal Reserve Act. What the congressional debate then produced was a question that the record shows was not fully resolved in the legislative language. Would the Federal Reserve System concentrate financial power further or distribute it? The answer the archive provides is specific. The Pujo Committee report is publicly accessible, but almost nobody outside academic economics has read it. If someone in your life is trying to understand how American banking became what it is today, send this to them. The paper trail starts in 1913, and it leads somewhere most financial histories skip. The Federal Reserve Act created 12 regional reserve banks, a structure that its supporters argued would distribute power geographically, preventing the concentration the Pujo Committee had documented. The regional structure was real. The 12 banks exist, but the operational authority of the system, the decisions about monetary policy, about reserve requirements, about the discount rate that determined the cost of credit across the economy, was not distributed equally across the 12 regions. The New York Federal Reserve Bank, from the earliest years of the system's operation, exercised an influence over monetary policy that was not proportional to its nominal status as one of 12 equal institutions. Its proximity to the major money center banks, its role in open market operations, its relationships with European central banks, all of these factors concentrated effective monetary authority in New York in ways that the regional structure of the act had not prevented. The small banks did not disappear immediately, but the competitive landscape they operated in had changed in ways that would, over the following decades, systematically favor Wascony over locality. The legislative record of December 1913 is where the story gets precise. The Federal Reserve Act passed the Senate on December 19, 1913, and was signed by President Woodrow Wilson on December 23, 2 days before Christmas. The timing was not accidental. Congressional sessions in December operated with reduced attendance. Senators and representatives who had returned to their districts for the holiday recess were not present for the final vote. The historical record shows that the act passed with a significantly smaller quorum than the debates that preceded it had generated. This is not evidence of fraud. Legislative timing is a standard tool of congressional management used by both parties across American history, but it is specific enough to note, because the men who managed the timing knew what they were doing, and the record shows they knew. Senator Nelson Aldrich, whose name had been on the original Jekyll Island draft, did not vote for the final bill. The Aldrich Plan, the version of central banking reform that emerged directly from Jekyll Island, had been rejected by Democrats as too favorable to the large banks. The Federal Reserve Act was structured differently, with the regional banks and a Federal Reserve Board that was nominally government-controlled. Aldrich opposed it publicly. What historians note is that the substantive monetary mechanics of the final act, the reserve ratios, the discount window, the structure of open market operations, were not significantly different from what the Jekyll Island group had designed. The political architecture changed. The operational architecture did not change as much as the political debate implied. Paul Warburg, who had been among the architects of the Jekyll Island Plan and who became one of the original members of the Federal Reserve Board, said as much in a letter written years after the Act's passage. His correspondence, portions of which are held at Yale University's archives, describes the Federal Reserve Act as achieving, in its operational essentials, what the Jekyll Island Group had sought. The political language changed to make passage possible. The monetary architecture remained. The system that the 8,000 national banks had operated in was not replaced by something neutral. It was replaced by something designed. The specific design question that the archive raises, and that the congressional debate of 1912 and 1913 did not fully answer, is the question of who the lender of last resort serves when it intervenes. The Panic of 1907 had been resolved by J.P. Morgan, organizing a private consortium of large banks to shore up failing institutions. The human cost of that panic, the bank failures, the credit contraction, the unemployment, had been borne primarily by small depositors, small businesses, and agricultural borrowers who had no seat at the table where Morgan organized the rescue. The Federal Reserve was designed in part to prevent the recurrence of that dynamic, to create a public institution that could intervene in financial crises without requiring a private billionaire to personally decide which institutions were worth saving. What the historical record of the Federal Reserve's early operation shows is more complicated. The first major test of the Federal Reserve System as a crisis manager came in 1920 and 1921, when a sharp agricultural deflation, driven in part by Federal Reserve credit contraction, produced a wave of rural bank failures that hit the small, locally owned state banks disproportionately. The large national banks, with access to the Federal Reserve's discount window and with diversified portfolios that extended beyond agricultural lending, weathered the contraction with significantly less damage than the institutions that served rural communities. Archival patterns suggest the Federal Reserve's credit policies in 1920 and 1921 were not designed with the rural banking sector as a primary consideration. The discount rate decisions that drove the contraction were made in New York by men whose primary frame of reference was the money center banking system, and whose understanding of agricultural credit cycles was not equivalent to their understanding of commercial and industrial credit. The small banks failed. The large banks survived. The Federal Reserve's first major test as a crisis manager produced not an equal distribution of pain across the banking system. If this is landing differently than you expected, subscribe. The next investigation follows the paper trail of what happened to the communities those small banks served after the banks were gone. By 1930, the number of banks in the United States had declined from its pre-Federal Reserve peak. The decline was not uniform. It was concentrated among the smaller state-chartered institutions, the locally owned banks that had served agricultural communities, small industrial towns, immigrant neighborhoods in mid-sized cities. The large national banks and the money center institutions grew. The small banks contracted, failed, or were absorbed. The Federal Reserve did not cause all of this. The agricultural deflation of the 1920s had structural roots that preceded the Fed's existence. The consolidation of American industry was a force that would have pressured small banks regardless of monetary policy. The archive does not support a simple causal story. What the archive does support is a more specific observation. The system that was designed in secret on an island by men who represented the largest financial institutions in America did not produce outcomes that were neutral with respect to the size and locality of the banks it governed. The record shows what was built. It is quieter about what was lost. The Federal Reserve is not going anywhere. This is not an argument for its abolition or a claim that the pre-1913 banking system was superior. The panics were real. The instability was real. The human cost of a financial system with no lender of last resort and no coordinated monetary policy was documented in congressional testimony and in the lived experience of every American who lost a deposit, a farm, or a business in the contractions of 1873, 1893, and 1907. The Federal Reserve solved a real problem. What the archive asks, and what the official history of the Federal Reserve does, not always foreground, is what was traded away in the solving of it. The 20,000 banks that existed in 1910 were not all good banks. Many were undercapitalized, some were fraudulent. The state regulatory frameworks that governed them were, in many cases, inadequate. The correspondent banking relationships that connected them created systemic fragility that the panics exposed with regularity. The case for reform was not manufactured. It was real. But those 20,000 banks were also the primary credit infrastructure of the communities they served. A farmer in rural Nebraska who needed a loan to plant his crop was not borrowing from an institution in New York. He was borrowing from an institution whose directors lived in his county, whose depositors were his neighbors, whose lending officers understood the seasonal rhythms of agricultural credit in a way that a money center bank, optimizing for a national portfolio, was not structured to replicate. The credit infrastructure that those banks provided, the local, relationship-based, community-embedded credit that financed small farms and small businesses and immigrant entrepreneurship across the American interior, did not have an equivalent replacement in the system that followed. The Federal Reserve could stabilize the money supply. It could not replicate the local knowledge that had been embedded in 20,000 independent lending decisions made by 20,000 institutions that were accountable to the communities they served. The meeting on Jekyll Island produced a system that has governed American monetary policy for over a century. What it did not produce was a plan for what the communities those 8,000 national banks served would do when the banks were gone.